Here we go. Hi, it's Alice Kuder with Berkshire Hathaway Real Estate here in Seattle, Washington, and I'm welcoming you to the real estate roller coaster with my co-worker, co-friend here.
Hi, I'm Evie Knoke, Senior Loan Officer with Guild Mortgage.
And today we're going to talk about barriers to home buying, particularly things like how much of a down payment you need. And a lot of this is Evie's specialty, so we're going to start with her.
Yeah, I think the most important thing, the most surprising thing that I have found when I'm listening to clients, people who want to purchase, is that they're like, well, I don't have 20% down, but can I still purchase? So there definitely is a feeling out there with home buyers, first time home buyers, that they must have the 20% down. And that's not true. That's a huge barrier to entry right now. If you can imagine the home prices, how expensive things are, 400,000 to pay to save up $80,000. I mean, you're better off paying off your student loans, your other debt, getting that all squared away so that you feel comfortable with the payment. And luckily, there are down payment assistance programs. And there also is what we call mortgage insurance. So if you have less to put down, that's okay. You will have another little extra payment with your mortgage payment, but it really helps quite a bit. So just to get an idea, during the Great or before the Great Depression, you always came in with 20% down. That's what banks expected. So they wanted that 20% down. Then the Great Depression happened. A lot of folks lost their homes. And so in 1934, HUD came out with FHA. And they said, okay, Mr. Bank, don't worry that you don't have your 20% down. Lend to these people because they wanted to really, help promote home ownership and get people back to buying homes. That was back in 1934. And they said, don't worry, Mr. Bank, you will have a little extra insurance policy, but they'll have to pay every month, but it will insure you for the fact that they don't have the 20% down. So then FHA was like, well, don't worry, Mr. Bank, lend to them with only 5% down as time went on, and then it was like only 3.5% down. So we have a lot of low down payment programs. FHA is one of them, but there's also other programs that are 3% down on the conventional side. And when I say conventional, I just mean not government, not FHA or VA type of loans.
What is FHA? What does that stand for?
It's, FHA is a department of HUD, and it's Federal Housing Administration. So that they really are almost like a big mortgage insurance company if you think about it, because yes, they're an investor and we have to underwrite to their guidelines, but they really help insure the loan. So they allow for more flexible financing in terms of higher debt to income ratios, lower mortgage reserves, lower credit scores. I mean, so typically most home buyers that are entering, especially if they're younger and they haven't had a chance to build credit, are going to have a lower credit score. They're going to get hammered on a conventional loan, which is very credit score sensitive. So if, for instance, if they have a 620, 600, 640, up to maybe even 680, they're going to have a much higher rate on a conventional loan. FHA is more forgiving. FHA will say, it's okay, you know what, we're going to still give you a good rate, but we're going to have this mortgage insurance as well. So it's just more of a forgiving product that has more flexible guidelines. It has lots of other things as well that will just make it easier for someone to qualify.
Okay, so they won't have to have as much down.
Mhm.
They're going to be essentially backed by the government, is right? The FHA loans are one of the reasons they're cheaper for us is because they're backed by the government.
They're highly insured by FHA, and FHA is part of HUD, which is part of
Okay.
HUD.
And HUD stands for Housing Urban Development.
Very good, Alice.
Okay. Now, don't you have to have two kinds of private mortgage insurance, PMI, with FHA loans?
Well, one thing I want to say too about the FHA before I forget, it's actually not just for first-time home buyers too. So that is for repeat buyers. It's something that somebody can use if it's their second time around. So again, if for any reason we just need more flexible guidelines for that home buyer,
Mhm.
um, there there is an upfront mortgage insurance charge. However, that is, we can roll that into the loan amount. What I mean that it's added to the loan amount, so it's no additional cost out of pocket. But it's a very good point to mention because that is how FHA sort of reserves, kind of builds up their coffers of money to help insure, right? If just like back in 2007, we had so many homeowners that started to um, default right on their mortgages, and the majority of homes at that time were with private mortgage insurance, which is on a conventional, just meaning non-government, just a standard conventional loan. And back then in 2007, 2008, those private mortgage insurance companies had to be bailed out by Warren Buffett, at one point, by Obama, at the end of the year. And then later on, I think Warren Buffett actually bailed them out as well because they had to pay the lender the insurance for those folks defaulting. Of course, the lender still goes after the borrower for the rest of the money, but on that first top 20% down, they provide that insurance. FHA is like a mortgage insurance company all itself, so it's not private. So how they build their reserves and their money is by taking a certain percentage, like maybe 1.75% right now on the loan amount as a fee, but then they add it to the loan amount so that this home buyer doesn't have to come in with it because again, the first time home buyers don't have that extra money
Right.
side, but they do get that money, and that's how they have built up they're basically they're sitting pretty well right now. There was a time period, I think even 5, 6 years ago, that everyone was worried that FHA wasn't going to have enough money, and so they changed some things, and they're sitting pretty good right now. But they're like a big mortgage insurance company because they do heavily insure because on riskier loans. So face it, an FHA loan is going to have a lot more risk layer than a conventional loan.
Okay.
And that, so in a way, they're sort of like a subprime. And if anybody remembers what subprime is, or you can Google it, it's sort of, that was sort of that's not your A paper, that's more your C and D paper type of lending. FHA in a way is sort of like a subprime type of a loan. And so it allows for, sorry, allows for a little bit, just helps those folks get into home ownership because I that is the best thing that we can do, and because it's really so amazing how much equity that you can build in your home, and it just strengthens home buyers and American folks all over the country. So it is really important for the government feels that it's important for them to really help folks be able to purchase their own home and start to build wealth.
Okay, so let me do a little bit of kind of summarizing and making sure I've got it right from
Okay.
a non-lender point of view. So somewhere along the line, banks decided that 20% of the amount of the loan was something sort of a safety barrier for them. And that if you're putting down less than that, they want, they essentially take out an insurance policy that says if you default, they get paid back. Is that kind of what that it comes down to? Okay, so this private mortgage insurance, so it's, as you say, there's ways to finance your down payment if it's less than 20%. But if it is less, you're going to have an extra charge rolled into your monthly payment that is for this private mortgage insurance. And then what we haven't talked about yet is to get rid of that extra charge and reduce your monthly payment. Once you've made at least 24 payments in a row, and assuming that the value of your house keeps going up because prices keep going up, once you get to where the equity in your home is equal or greater to 20%, then they can remove that private, the PMI, the private mortgage insurance, and your payment would go down, maybe several $100s a month. So is that all accurate?
That's very accurate. Good job, Alice. Yeah, it's a minimum of 2 years at least. it's something that you can go back to the investor and say, and you would do that through who's servicing your loan. They would help you and to say, but this is, but I want to make sure that too, that you know that that's not on FHA. FHA, you can't remove the mortgage insurance, but on a conventional loan, you can. In most cases on FHA, you can't remove the mortgage insurance anymore. That was a change that they made when they started to realize they were running low in reserves. So they kind of changed that back in 2014. And so now you can't remove it. You would have to refinance out of that loan in order to remove it.
Okay.
On a conventional loan, you can remove it with a minimum of 24 years, on-time payments,
24 months.
depending,
Months.
24 months, sorry, 24 months, on-time payments, and depending on where we are in the market, if we are depreciating at all, I mean, the investor will say, no, sorry, maybe I want you to have 35% equity. We haven't really seen that so much over the history, but of at least how over the last 15 years since I've been doing loans, but you definitely can't do that before 24 months. And and when you do that, you have to get an appraisal. And so what we're saying is like, okay, Mr. Investor, I bought it for this much with 3% down. It went up another 5% over the last 3 years, and I paid down a little bit. And here's the appraisal to show the value. So please remove my mortgage insurance. And so when you have a good lender that's with you, that are looking at that on your annual review and making sure that for any opportunity for you to save money and actually kind of advising you as well as that. But another good thing to note is that at 78% loan to value, meaning when you have 22% equity position and you pay down the loan that much, it automatically is removed. And how many years it takes? Well, it really depends on, did you put 3% down or 5% down or 15% down? But at that point, it's automatically has to be removed. When you have 20% equity and you pay down from the original purchase price, then you can request it be removed. And what you're saying is a third way, faster way, is using the equity that you've built, the appreciation that you've got, that you've received, plus paying down, using that to remove it.
Yes. And that's where your agent can be helpful too. I try to always keep in touch. And once you've closed a sale with me or I've helped you buy a house, that's not the end of my service. I stay in touch. And one of the ways that benefits you as a buyer, we're talking about right now, would be you can every once in a while reach out to me and say, hey, we reached our 24 payments in a row. What is the current market value of our house? And I can run a CMA, a comparative market analysis, that will give you a good estimate of what it's currently worth. And if we establish that you have probably met that goal of now combination of your payments and your equity, you've reached that 20% mark, then we would go to your lender and say, hey, what do you think? And they would probably order an appraisal, which is going to cost you $750 about right now, I think appraisals are, but could easily save you that much pretty quickly. And of course, there are some refinancing charges too, right? Do you want to talk about
Not if you're just removing the mortgage insurance. So
oh, good.
Refinance. Yeah.
Unless you went from FHA to conventional, then that would require a refi, right?
It would, yes, because there's no way to remove the mortgage insurance on a FHA loan.
Right. So you have to finance out of it into a conventional. Where does that term conventional come from? I always find that a little odd. Do you have any idea? I don't know why you would know that.
I just know that it really, how I explain it is that it just means, it's just what we say, just to know that it's not an FHA or VA loan. It's not a government loan, it's a conventional loan.
Okay.
It means non-government.
And those just come from regular banks or credit unions, right?
Mm-hmm.
Okay. All right. Let's see. So what's the minimum you would have to have? What's the lowest anywhere that you could, smallest amount you could put down? Is it 3% still, or 3.5, or?
Well, if you are a veteran, you can put 0% down. So
Okay.
that's really, those VA loans they're really the best loans around, because they don't have the monthly mortgage insurance as well. So that's a real big benefit to, so if you're a veteran at all, anyway, if you're eligible for some VA entitlements, then that's the best loan in town.
Okay.
You do pay that an upfront mortgage insurance kind of thing, and again, that they let you add to the loan amount. So, but it's how VA also self-sources for mortgage insurance in case of default. The next tier really is 3% down for first-time home buyers.
Yeah.
Have to be a first-time home buyer. And if you're not a first-time home buyer, then you're really having to put 5% down.
Okay.
Now, but with FHA, whether you're a first-time home buyer or not, it's 3.5% down.
Okay. And anybody can get an FHA loan, right?
Correct.
Okay.
Correct. Don't have to be a first-time home buyer. Yeah. Now you can't have an existing FHA loan and try to get a new FHA loan. They won't allow that. You just have to have one at a time.
Okay.
Get one. Yeah. And along with that, those are the standard down payment that are required. But you can also go through the Washington State Housing Finance Commission, and as long as your income is under 148,000, you can receive down payment assistance. That is an even faster, better way to get in the market and start earning equity. So that means that you have your 3% down, but that down payment assistance is actually a loan, a second loan that you borrow from the Washington State Housing Finance Commission, but it's at 0% and there's no payments on it for 30 years. After 30 years, you have to pay it off. You can pay more on it if you want, but the majority of folks actually end up selling that home after, let's say, 8 years or so, on an average, and that gets paid off automatically with their proceeds, because again, they bought the home and they've been earning, they've been appreciating and getting equity, so that's how it gets paid off. Or if they do a refinance, we're refinancing because maybe they purchased and that rate was higher. They did the down payment assistance, but now they also have equity because it's been 3 or 5 years. We're going to refinance that loan and we're going to pay the first loan, but we have to pay the second loan off. So they won't let you just keep it there. Unfortunately, we have to pay it off. So when you refinance or sell is when that loan gets paid off. But the fact that it's 0% and it's there, you don't have to make any payments on it whatsoever. It helps us qualify people easier. And it really helps, again, folks to get into home ownership, because not only do you have to earn the 3% down or, save the 3% down, you also have to pay for closing costs. So those two things are quite, can make it longer for someone to get into the market of buying a home. And that really helps shorten that process.
What other places can you get down payment assistance other than the Washington State Bond Program? Where would someone go if they wanted to research that?
Well, there are so many banks and credit unions and lenders that even have their own down payment assistance programs. So it's good to check with your credit union, with your bank.
And then just Google it. Google down payment assistance programs, or
yeah, and Guild Mortgage, we have our own in-house one as well. I know Wells Fargo has some down payment assistance programs, probably Bank of America. So those that's where people should check. But yeah, there's quite a few besides just the Washington State Housing Finance Commission. And then but when you take the home buyer class for the Washington State Housing Finance Commission, it's like a 5-hour class. You learn a lot about the different grant programs that are available as well. So you do have to make a lot less income to qualify for those grants, but that's very informational. Yeah.
And when I say to Google for those, the one caution that comes to my own mind, I don't know if you can speak to this or not, is I wonder, there's probably some scammers out there who are waiting for people to ask about those things. Are you aware of anything that would be a red flag to say this isn't a legit program?
I'm not, Alice, but sometimes I feel like when people Google, they are pulling up older information. Then because I have people then come to me and say, what about this? And I say, oh yeah, well that's no longer available. So unfortunately, sometimes you're not getting as current information, depending on how far you're Googling. Right. So that's really the one thing that you have to watch out for. But a lot of the times you can find out information on the particular websites. Pierce County has like a down payment assistance program. Tacoma does. Also, a lot of times the different, areas and counties have things. Yeah. But the Washington State Housing Finance Commission is a good place to start.
Okay. So some down payment assistance are going to be government sponsored, and others are going to be sponsored by commercial banks and lending institutions.
What we call their own portfolio lending, their own, what they're doing, what they're wanting to do to promote home ownership and help with that. So definitely programs and different flexibilities. Some they're going to offer it, but there's going to be an income cap. Some are going to offer it and they're going to be really strict on debt to income ratios, or some are going to offer something and they're going to be really flexible depending on what that bank is. Again, they're going to be their own money. So it's going to be a bank, a big bank, national bank, or a credit union. It's going to be their own money and sort of how they're feeling about lending at that time. And sometimes those programs definitely change. So they go in and out, again, depending on the reserves and sort of the appetite that bank has for lending on those type of programs. Because sometimes if they're very flexible with credit and they go down with lower credit scores, they're a little more risk based. So just depending on, again, what I would say, it's grandma's money when it comes to that kind of stuff. So it's really depending on how good grandma's feeling about lending the money.
Okay.
Yeah.
You used the term portfolio lending, and which might not be familiar to everybody. Do you want to just give a brief explanation of that?
Yeah, that's kind of why I say like grandma's money. So it's like Bank of America, their own money that they have from all the deposits of all the checking and savings account customers that they have, and what they have and what they're able to lend. Wells Fargo, or whatever their other type of bank, it's their own money. They call that portfolio money.
And what would be the alternative to a portfolio? Where would they get the money if it isn't their own?
Through the secondary market. So
Okay.
when it comes to the majority of home programs that we have, the two investors are Fannie Mae and Freddie Mac, and they are really in receivership right now. Like the American taxpayer owns Fannie Mae and Freddie Mac right now. Still, they're wanting to go public again, like they did before 2007, before the big mortgage meltdown crash. But right now, they are on Wall Street, but they're just not quite publicly traded yet. they're not public. They're not back. They are owned by the taxpayers at this point. They're in receivership, and they are operated and managed by FHFA, which is the Federal Housing Finance Authority or Administration. So they are managed by that. So they're the ones that we are all underwriting to. We are closing in our own money, whether it's a big national lender like Caliber, Guild Mortgage, Cross Country Mortgage, whatever. We're loaning the money in our own money, our own warehouse lines, closing that. But then we're turning around and selling the notes on the secondary market back to Fannie Mae and Freddie Mac and getting paid from them on that. So it's a cycle of money. That's really where the majority of lending is, because there's not one single bank or out there that could supply all of that money.
Right.
That is needed for all the home loans that are done every year. So it has to be a cycle of money where it's like, we've got the money, don't worry, we're going to close on it, but then we're going to turn around and we're going to sell this a stack of notes, like for $102 billion worth of notes, like mortgage notes, and we're going to get $106 billion on the market. So that's sort of the cycle of money, and then the money comes back, and then that's how they can keep doing that. Yeah, but portfolio money is different. They're not that's their own money.
Okay. We're going to stop there for today. We'd love some feedback from you. Wondering if we're using too much language that is so familiar to us that we forget it might not be familiar to you, both on both our ends. And whether or not we're being basic enough, too basic, too complicated. So we'd love any kind of feedback from that, of that from you, as well as any other topics you'd like us to cover in the future. So for now, thank you for joining us. Stay safe, stay healthy, and we'll see you next time.
Bye, everyone.